As I was getting ready for this presentation, I actually was reviewing some of the things that I really got wrong last year, whether it was inflation or interest rates. So take this for what it's worth. It's actually a real challenging time. As we all know, the markets are reflecting a very difficult global economy, both from an economic, geopolitical, and social perspective. We've had crazy elections going on around the world. For those in the Philippines, the Marcoses are back, which I don't know what that says about what's going on around the world, but if there was anything left to take, I guess they're going back for more. But it seems like we've had just a crazy period with big losses in the investment markets as we've gone from a period of highly easy monetary policy to one that's been getting tighter by the day. So I just want to go over and take a quick look at the Russell 3000, talk about whether the Fed can engineer a soft landing, and where to put capital work today. So there's been a tremendous amount of damage done in the markets. This is off the 52-week highs. I'll give you the summary of it. 78% of the stocks in the Russell 3000 are down 20% or more. And it gets even worse. Only 4 of the stocks in the Russell 3000 from their 52-week highs are positive. 23% are down 20% or less, and the rest are down between 20 and 50, and 31% of the stocks are down 51% or more. Pretty significant damage, but it's not just the Russell. CNBC announced today that by their calculations, more than half the people invested in crypto are underwater on their investment. The London Business School did a study on meme stock trading, and they estimate that people lost between 1.1 and 1.4 trillion in meme stock trading. Morgan Stanley came out with a number that said they think it's around 900 billion in losses there. So clearly the market is going through a very difficult period, and yet we had a pretty significant sales at auction yesterday for art. So there is a lot of liquidity in the system. So where do we go from here, and where are the opportunities? So let's start with, can the Federal Reserve engineer a soft landing? It's going to be very difficult if rates keep moving up and the supply and demand dynamics worsen. And I really mean core inflation, what it does to core inflation, not energy and food, because they're going to be persistently high as long as the war persists. But I think what we can really need to look at is, are there pockets where we're starting to see inflation flattening out and then or decelerating, and is that the sign of a start of a turn? I think consumer spending slowing due to inflation or uncertainty around job security could certainly push us into recession. We don't think that's the core case. We think the difference between the haves and have-nots will be enough to keep the spending at an appropriate level. But whenever the Fed tightens, there is usually a problem somewhere that pops up in the world, whether it was the emerging market crisis or the currency crisis in '87 or different areas. When we had tightening, something seems to break. And that is one of the concerns, is the credit markets, are they in for potential shock? Not sure if that's the case or not. I think the issue about a global recession, where the probabilities are much higher than a US recession, could really hurt multinational profits and spill over to the economy. And all of the fears around recessions actually play to themselves and become somewhat self-reinforcing. So we have to be careful about that. Our base case for the US is that we probably won't have a hard landing if the war doesn't persist for too long. And depending on the policies of Europe around energy, headline inflation could stay high for some time, because this the Gordian knot that exists between Germany in particular and Russia on how do you deal with moving off their energy and keeping your country running is going to be a tough one. And it is the 4th largest economy in the world, so we have to keep a close eye on that. But you have seen some sharp tightening in the markets for some time now, and this is the 10-year Treasury with a 5-year look back. And we've had a very significant move up in rates in a very short period of time. This is the headline risk. This is natural gas and crude, natural gas and in the blue, crude in the red. And you can see that this is not a situation that will likely rectify itself quickly. So headline inflation should remain high, but we are seeing some signs of core inflation coming down. And I think what's needed for a soft landing is already in part underway. We've had much tighter financial conditions than we had before. You look at the 2-year, it went from, a low of, a recent low of 0.16%. Now it's added over 2.5% in a couple months. The 10-year Treasury from its low last August of 0.52 is now back at was around 3% today. Mortgage rates moved up over 2%. The NASDAQ moving down 23%. And as we talked about, Bitcoin and the crypto space getting hit pretty hard as well. I think the slowing of global growth does allow for some supply chain issues to ease, but you still have what's going on with China and their lockdowns adding to the pressure. So I think there's no easy calls on this right now. And as I said last week, this is one of the most complicated and uncertain periods in our investing careers. And regardless of how long you've been in it, this is one of the tougher ones. I think one of the underappreciated issues is the relatively strong household and corporate balance sheets, which should allow for continued demand. House prices have really helped the household balance sheet, but as has their focus on paying down debt since 2008. And corporations have received over 2.3 trillion in new issuance, either refinancing existing debt or adding to debt, taking advantage of the low rates, which should position many of them for positive outcomes coming forward and not having to rely on the credit markets so much. So there is a growing view that inflation may be peaking. It's a very difficult call right now because there's so much uncertainty out there, particularly around the war and around how sanctions are going to continue to work and also how COVID's playing out. But you have seen revenues getting hit hard, particularly for stay-at-home beneficiaries. Peloton is down 90% off its high. You've seen other Teladoc and other of the big stay-at-homes getting hit pretty hard. But we are seeing good prices easing, and we're seeing a number of areas that are not getting the same headline attention that you've seen. So, I wanted to step back and take a look at the 10-year Treasury since 1962, and that gives you a very different perspective of where we are overall with rates and how this move up. While it feels like a lot, we're still in a highly accommodative period for interest rates, and there is a chance that they could start easing back down again. The 30-year fixed is really a bigger issue, but again, historically, going back to the 70s, I think you have to go back close to the 50s to see rates sub 5%. And it wouldn't surprise me if we do not move up too much from where we are right now. But I think one of the interesting things, and this is one of the areas that's gotten a lot of attention for inflation, is used car and truck prices. And you've started to see that come down. You've also started to see wage increases starting to decelerate. And that could turn too, because we do have the big JOLTS number with 11.5 million job openings, almost 2 jobs for every person unemployed right now. So that will push wages up, but also we're starting to see some layoffs as a counter to that. Small business confidence is down. So there are a lot of countervailing forces here. So for our view, what should you do now? I think the focus is really on quality, liquidity, and shortening up your duration. I think as we look out, you're going to see the quality stocks do quite well, although I will say the FANGs lost, I think, roughly $1 trillion over the last 3 sessions before today. But that doesn't take away the valuations that still look pretty attractive for their growth rates and financial strength and balance sheets. I think you still want to invest in the durable secular themes. And Cathie Woods is getting a lot of criticism right now because she was such a high flyer last year and she's gotten hit very hard this year. But one of the things that's different about Cathie Woods from most other investors is she's looking at 3 to 5 year themes and investing for them. So she's less concerned about the short term, although I would say the last 4 months she's been quite concerned about. But I think the idea of investing where you can have clarity and not worry about the short-term swings as much is really where you're going to make your money. So that continues to be in the digitalization of everything, the electrification transition that's going on right now with green energy and clean energy. national security from a military, cyber, food, and energy perspective, commodity producers that are absolutely required to support the tech advances. And all these guys have gotten caught up in the downdraft, and they're creating some really great opportunities to buy. Biotech companies that are improving healthcare quality at a lower cost. We had one of our portfolio companies taken out at a 73% premium today. And in the healthcare space, we're quite pleased with that, although we would have preferred a 73% premium from its high a couple months ago. But I think this is a sign of M&A picking up and where opportunities are going to be. If you can lower cost, you're going to be a beneficiary in this environment. I also think quality dividend payers are going to continue to be a good place to park cash as you're waiting for a little more clarity and for some of the dust to settle here. And even though the 10-year has moved up so much, where before they were at parity with the S&P yield of 1.5%, 1.6, I think when you're getting strong growth or quality growth at high single-digit growth with a 2 or 3% dividend yield, you're going to do well in this environment for a difficult period. So I wouldn't discount that area at all. Sometimes slow and steady is the right way to go. We definitely continue to favor equities over bonds, domestic over global. Really, this is a balance sheet war that's going to be won by the strong, and they're going to take advantage of the weak in this period. And I think you're going to start to see a lot of companies with bad balance sheets have a real difficult time accessing the capital markets. And you really want to stay short. And in the fixed income area, if you think we've had a 2% move in the 10-year in a short period of time, that's cost investors in a 10-year bond about 16% of the value of their bond. So there is some real carnage that's being done here, but we think there are real opportunities, and we've been actually nibbling around at things we really like that have pulled back a lot. We are not giving up core positions and have really been running our cash at a fairly modest level of the 5 to 7% range, somewhere around there. I think the extremes in valuations are going to continue to see real adjustments to it. You're going to see multiple contractions for the high multiple stocks. And even with the re-rating, some of them just don't make any sense from a valuation perspective. And without the real Fed put supporting them, it's going to be very difficult. I think earnings and CapEx will drive stock performance, but you also have to have a positive outlook because strong earnings for the quarter with a negative outlook are getting really beaten up badly. And I think this is the first time probably since the great financial crisis that you really have to think about owning stocks, not the stock market. You want to own a basket of stocks that are going to be the beneficiaries. The whole market is going to struggle with the challenges that exist in the market today. So I'm going to stop there, Mark, and open up for comments and questions.
Thanks, Stephen. Comments and questions?
Stephen, it's William here. Can I ask you a question on the commodities and the domestic market?
Yep.
Southern Copper Corporation, ticker SCCO, very attractive dividend. They were caught up in some stuff in Peru. Just a question about how do you kind of reconcile domestic versus international when you got commodities that are going to be all over the world? What's your view, I guess, on the commodities?
Well, that's a great question. I think you have to separate the commodities out from what commodities you're owning and for what reason. And copper is a good one. We don't invest in Southern, although we have in the past. We've chosen one of their competitors to invest in. And it's really a question of, for us, does it fill a national need? A national security need, and the commodity space is actually essential to the production of a lot of the digitalization and electronics that we're going for. So, an EV has 10 times the amount of copper that an ICE has. So you need to have exposure there, but you also have to watch where it's sourced from. And it's not going to appeal to many of the ESG folks, although I think there's a real question for ESG of how do you look at national security versus environmental issues or social issues, and how do you reconcile them? That's an answer for somebody a lot smarter than I, but I think you want to own the stuff that is essential. So for us, it's copper, it's steel and it's rare earths. And we look for domestic producers in the rare earth area. That would be MP, and in the Western world, it's really MP and Lynas out of Australia are the two that would be the most secure. But they both need to build up their refining capacity and get their volumes up in a bigger way. So I think you really have to be careful about the jurisdiction, and you have to know which ones you're owning and why, and not speculating as much on the price, but believe that there's a strong demand for the market that it will be hard to meet due to the supply issues. So I think that's the way we would step back from it and think about national security and the essential strategic nature of the commodity. It is a place that the dollar strengthening has hurt it in the near term, so it's created some really attractive entry points to buy as well.
Thank you. That's really helpful.
Stephen, do you have a view, in sticking with commodities, do you have a view on foodstuffs, wheat and corn, and particularly as it deals with Africa?
Yeah, I think I do. I think we have a real issue there that's going to continue to escalate into social unrest because I think unless there's a way to unlock the wheat and grain supplies from Russia and Ukraine during the conflict, I think we're going to have some pretty extensive shortages from what I understand. And I think that's going to hit the Africa hardest. And I think it's going to hit all the lower income countries and people the hardest. And we're going to see real food inflation stay high. And I think that's going to be an issue for a while.
Where would the potential food substitutes be, or supplier substitutes be?
You would look in South America potentially, but I don't know that they can make it up as fast as they need to.
Thank you.
Other questions, comments? Greg, I don't know, since last week, you didn't really have a chance to comment on that because we couldn't hear the people on Zoom. Any thoughts on emerging markets?
Sure. So it's been a bloodbath, right? Just for reference, the emerging market index that everybody follows is down 17.8% this year. Things that were doing well at the beginning of the year are not doing well anymore. And this has to do with just basic reshuffling of portfolios, the threat of interest rates going up. Now, structurally, EM is in a better. Stephen was mentioning the things that tend to break along the way when you enter these processes. And what's interesting about EM is, structurally in general, most EMs are better off than in previous tightening cycles. But the problems we're having is, for example, what's going on in China. A lot of doubts in terms of the lockdowns, and that's spreading all over the world. Supply chains is another thing that's coming back to the forefront. And then with all that noise, what you're getting is another thing that Stephen just highlighted, which is, a family like the Marcos family coming back in the Philippines, and the political shifts you're getting there. So I think William was asking about Southern Copper. Problem with Southern Copper is that politics in Peru are a mess. I think the president's going over his fourth impeachment attempt. And just recently, they've had a big problem removing indigenous populations from southern Peru mines. And so, that illustrates this big difference between the have and have-nots. This is an ESG issue, so you're getting stocks that you would think should be performing well. This is the problem with emerging markets, right? So when the financing chain breaks, right, then the governments become rent-seeking. And where do they seek rent? They seek rent where they can get it, usually from businesses. And these commodities tend to be very, very controversial. People say it belongs to the people and not the companies, and that they extract monopoly profits, and that should be awarded back to the people. So that's why you're getting this type of performance out of companies like Southern Peru. So Yeah, it's a pretty big mess. Pretty big mess out there.
Greg, it also creates challenges with cross-border investments and foreign direct investment coming in when you have no confidence. Can you see any oil companies going back into Venezuela from the major oils outside of Venezuela? Very difficult to have confidence that you put a lot of your capital to work there in countries like that.
Yeah, exactly.
Which then perpetuates them getting out of the problem that they're in, makes it very difficult for them to undo without new money flowing, and puts a lot of strain on IMF.
Here's another really interesting thing. I don't know if some people remember, about 2 months ago, I highlighted there was a JP Morgan report on Chinese tech companies where they came out with a blanket sell on 21 Chinese techs and basically said in an official JP Morgan report that the space was uninvested. Apparently today, there's a story on Bloomberg saying JP Morgan apologized and said the report was issued in error. Now we can speculate why that is. I have ideas. I mean, they basically probably got caned in China, and it threatened their whole Chinese operation, and now they're retracting. But that's another problem of investing in emerging markets. But you can't not. We're gotten to the point where in the largest economy in emerging markets, second largest economy in the world, you can't really speak your mind if you're an analyst, because if it upsets the government, then you can't say it. And these things tend to come to the forefront always at the worst possible times.
And Greg, didn't you have a leading investor or leading economist walk away from their firm because they had negative comments? And it was just announced yesterday, I forget who it was, a star investor in Europe, in Asia, pulled away from the government.
I may have missed that.
It is tough to be critical.
Mm-hmm.
Anyone else? Thoughts, questions?
Did you guys comment on the Fed meeting last week? Because that was a tough one, right?
Yeah. We didn't really touch on it too much in the presentation. I think the challenge for Powell is how much work does he have to do and how much is the market going to do for him? Because the Fed is actually clearly all about inflation right now, because they don't have to worry about jobs with a 3.6% unemployment rate. So they're going to really continue to focus on it. But I think you're starting to hear comments from Bullard and others that the Fed is on top of it now and in a good spot, which was surprising for Bullard to make that kind of switch. When other former Fed governors like Dudley and others are saying they're still behind the curve. So I think it's a really challenging environment that you could argue for a recession as easily as you could argue for a soft landing. Yeah,
I mean, I'll throw one out there. I think this will go down as one of the worst Fed press conferences in history. I was surprised Bullard didn't dissent, because a week before, during the IMF meetings and at a meeting, specifically at a speech he gave in Princeton, he talked about 75 basis points, and then Powell took 75 basis points off the table categorically, and Bullard didn't dissent. He had been a dissent in the last one when they raised 25 and he wanted 50. Loretta Mester just came out to say 75 basis points is not off the table. So that's one. Second is the way they decided to announce the balance sheet runoff. Very phased in, 3 months of 47, and then eventually you get up to 95, and then start June 1. So still today, the Fed's is rolling bonds when they mature. Despite the fact that we are where we are with inflation. When asked why June 1st, I mean, it's the worst answer I've ever heard. I tend not to criticize these things, but I was very surprised. We picked June 1 as we could have picked any other day. And so then I think Steve Leisman from CNBC followed up saying, well, why not today? And it's
interesting, Greg. I don't know if you saw that the Bank of Japan had restarted reducing their treasury holdings.
Yes.
And to the tune of about 60 billion, I think, last month, which would have been in the number that the Fed would have taken out in treasuries
Mhm.
at their max.
Yeah.
So,
Yeah, it's a big reshuffling going on everywhere right now, right?
yeah. And the other thing that's interesting is we're moving from a period where countries would want a weak currency to encourage exports, and they want now they want a strong currency to fight inflation. So very difficult for everyone to have strong currencies.
So I don't know, hopefully, let me know when you guys go to the next trip, because if we're gonna have a week like the one we had when you were in Chicago.
You're better off being away.
So I got married March 11th, 2000. And if you look at what happened, I was the head of tech investing for at the time, and I came back to a whole new world.
Mhm.
I went to Thailand, shut all devices. We didn't have smartphones. Came back, I was like, oh my God.
Yeah.
It's interesting though, Mark, for perspective, the NASDAQ dropped from 2,200 to 1,100 then, and then got as high as what, 13,600 or something like that now, 13,006, 20 years later. And at the time, people thought you weren't going to be investing in tech anytime soon again. So you really have to be careful about how you read into this and how you react to it. It's very difficult to get back into markets when you move to the sidelines. So you have to be very careful about making all or nothing bets.
Plus, you talk about bets. You talked about Bitcoin or crypto a little bit.
Yeah, that's interesting. It's been non-correlated in a down rate environment, but it's too soon to know if it's more closely correlated to the NASDAQ in an up rate environment. But we're going to have to see how they work in a rising rate environment. Does it still provide the characteristics that people are hoping for? And will you still get as many buyers coming in to move the stock up, the prices up? I think it's going to be an interesting study to see how it actually performs in this type of a rising rate environment.
Forgot to mention, there was an event this week, starting towards the end of last week, going on today. So the third largest stable coin, which is tied to a token called Luna, and a stable coin called UST, basically broke the parity, right? So these are supposed to hold the dollar parity. So apparently the owners are infusing a $1.5 billion loan, but it's still selling off today. And this illustrates this issue about what these not so much what the cryptos are, but what the stable coins that provide the on ramps and off ramps to be able to enter into crypto. They're financial institutions in disguise, essentially, or unregulated is what I'm trying to say. So this is part of what's putting pressure on Bitcoin as well, because these people at UST had to liquidate a large Bitcoin position to be able to refund their stable coin.
Yeah, that didn't get as much press as I thought it would have.
Well, yeah, this is the biggest issue, right? Because the way I think things are moving on the regulatory side is the SEC and bank regulators thinking about, if you want to run a stable coin, then you're going to have to be a regulated financial institution. And the crypto will then maybe be a security. The problem there is what's been happening is there's been crypto lending through stable coins at rates that were infinitely higher than what the US dollar rates were, yet these stable coins were pegged to US dollars. So the question is, what were these stable coins doing to be able to keep that peg and pay out those rates? And now you're having and let's say that they were holding, so the speculation was they're holding much more speculative securities than a money market fund would hold, right? And then you get a rising rate environment and those securities get priced down. And this is what happens.
I was just trying to do research on where this is going. We're due for another one of those and it's not going to be my "I told you so" panel.
But those are piling up, Mark, right? I mean, we spoke about what was going to happen to the meme stocks when the meme stock phenomenon was going on. We spoke about getting too far ahead on valuations, and we didn't have a timing. I mean, people who live on this day to day, like Stephen and I mean, we didn't say when, we couldn't say when, but you know, things mean revert to some sort of normality, and it's very painful.
Yep. Other perspectives? I like disagreement. Constructive disagreement. Different points of view.
Yeah, quick question. Stephen and Greg, actually, the two of you.
I disagree.
That's not constructive.
There you go.
The war, how is the war the key source of uncertainty moving forward for the global economy, or is it the war and China, or what are the right now, because this changes right now, what is the core source of uncertainty?
I would say it's the war and COVID still as it relates to China. And then obviously the impact of both of those on inflation are the primary sources of uncertainty from where I sit. And then, Greg mentioned it, the politics around the world is really moving up the rankings as things you really need to be concerned about, because you see how the elections are playing out and what's potentially ahead for the US election. And you have to think around the world, is this the best we got?
Yeah, so I would say it's all of it, right? But the main setup, I think, the one that sits in the background is the one where when you look at all the indicators, right? We went into COVID and we were all worried about debt levels around the world. We were all worried about wealth inequality. And we came out of it worse.
Yeah.
Because the prescription to deal with COVID was stimulate, then worry. And we kind of got to the point where we got to worry. And so that brings in the whole thing about global recession and, the cost of running this debt at higher rates, and who can refinance and who can't, and what businesses are viable at a 10-year treasury rate of, call it 3 vis-a-vis 1.5. Zombie companies, et cetera, et cetera. So I think, and then the issues that you mentioned, Adam, just pile on. But I think the backdrop is concerning, and how we eventually get out of it, and whether we have politicians in the world that are willing to undertake the political cost of trying to fix something, because it's going to be unpopular for a while.
Yep. I think you're right, Greg. The debt issue is one that is got to be a much bigger concern. I think we had global debt of around $208 trillion back when the financial crisis hit, and now it's closing on 300 trillion. And in a higher rate environment, a 2% move up in rates that's a lot of debt servicing that has to be made up,
right,
in a lower growth environment,
right,
or a recession. So.
Thank you, gentlemen.
I would say, Adam, though, I think it's important that there are opportunities to make money in this environment. These pullbacks have been so significant that there is capital to be put to work right now. And in 12 to 24 months, you'll be pleased you did. I just wouldn't go whole hog. I think you have to be very judicious about where you're putting it. And again, invest in a market of stocks, not the stock market. So,
Yeah, there are huge opportunities.
Yep.
Right now.
Tim, I need to give a shout out to you for all your help in Chicago. I just see you on camera. Of course, many of you here. Brittany might have, like, compared to your picture, Adam, show us your picture. Like, Brittany has like a real picture. Look at that. She was super helpful. if you take yourself off camera, we see your, and many of you, thank you for coming to Chicago. We are a lot of good content. If anybody has any thoughts that, oh, there she is.
Hi, sorry, I'm at the park.
Don't be sorry for that. That's where we all should be.
Learn to play, yes.
Any reflections you might want to share from the whirlwind from last week?
Any, did I miss a debrief that we may have had on that Chicago event? I thought it went well, but just thoughts, et cetera, from others.
Tomorrow, 10:30, we'll be going into that. So, but I just appreciated your help. I just saw you on camera. Maybe
Happy to help.
people can see all these in the digest. See the one that was thinking, Brittany, that you did. But many of these are interrelated here. And we talked about it earlier, Brittany, with Jack Wyant. And again, if anybody who could come on Thursday to Ohio, Jack's opening his house up for a nice little bit of a informal reception. But there's another Cincinnati Reds owner who's really focused on the same issue from a missionary perspective, and that's how we got Andre Norman last year. And so we'd like to continue the conversation with the impact panel and breakouts in Cincinnati for sure on that issue that you were
Yeah, I ironically was on a call with Andre Norman last night. So yeah, I'm happy to discuss offline the architecture on that, but I think that's a wise decision to continue it to Ohio.
Hey, Mark, can I ask one quick question of Stephen?
Yep. Go for it.
Hey, so Stephen, I was talking to my broker at Goldman the other day, and he was pushing tax loss harvesting. What's your opinion on that? As much as you can say.
Well, I think it's always good to do it as you go along, but a lot of people wait till the end of the year. I think you tax loss harvest along the way, not wait till the end. But I think you really have to, why you're selling. We don't sell if we think it's a good investment. We sell because we don't want to own it anymore. Even for tax loss harvesting, we typically don't sell something that we like as an investment. So I'm not sure what the motivation was for that right now, unless he has some stuff that the thesis changed and he doesn't think it's going to work out.
Yeah, I would just add to Paul's comment that I think the strategy is to sell an asset and buy another asset that is kind of a like and kind quality in order to still be in a relatively similar position and get the benefits of the loss.
Yeah, it's hard to find equal stocks that way, I guess is what I would say on that one.
I would agree with you, Stephen. This is your area of expertise.
Yeah, and you'd have to look at the book too. Each portfolio is different, and there are different times that it makes sense to do different things. So, but it's not the worst thing to be doing. We do look to do it earlier in the year too, but we also look to spread it out over a couple of years if we can, if we think there's an opportunity to do it that way as well.
Hey, Mark.
Yep.
It's good to see a bunch of people that I got to meet in person in Chicago, and it was my first live event and exceeded my expectations tenfold. So I want to put out a shout out to Ohio. If there's a way to get there, I'm going to go and hope to see some of these people
Awesome.
that were in Chicago or weren't in Chicago in Ohio.
Awesome. I was expecting a butt. But you didn't give me a butt. That's all right. You can still give me a butt.
We love
Tomorrow.
hearing,
We'll do that tomorrow.
Sorry, Ann.
we love hearing that. Jack and I'll make it work.
Yes. No, it's you want to just talk, give everybody like why they should come to the Cincinnati, to, you know, not just Columbus.
Sure. Let's see, wasn't ready for that unprompted request. So yeah, I think we'll have a full slate of great things that we're planning. We're still in the formative stages right now to some extent, and Jack and Mark and I are going to bear down on making sure that we create sort of the messy magical that Mark strives for. So we'll have a number of different panels. We're determining what the tracks will be, whether it's impact, sustainability. It'll be a Reds game we go to that will have a special suite for us. Jack's reception at his home. To be clear, it's an amazing penthouse condominium with an incredible view of Cincinnati. So, and making that just really casual and low key. Whenever people arrive, they arrive. We'll go to Centrifuge at Union Hall, which is sort of the catalyst and connector for all things related to the entrepreneurial startup system here in Cincinnati. What else? There'll be pickleball. There'll be pickleball. And there'll be options for people who don't want to play pickleball. And whether it be walking tours or an extended lunch with additional speaker opportunities, panel opportunities on the Friday. So a full slate of interesting stuff, we think.